Good morning. We will be starting in 1 minute to give folks time to join us. Good morning and happy National SBDC Day and also St. Patrick's Day for those who celebrate. I'm Rachel Garcia, the Program and Operations Manager at the Boulder SBDC. My colleagues Sharon King and Judith Jocks are here with me and will moderate the Q&A at the end of the session this morning. Okay. Welcome everyone to today's program, What We Know Now, COVID Recovery Grants and Loans. This program is produced by the Boulder Small Business Development Center to support businesses in Boulder County as well as the rest of the state. We are one of 15 SBDCs in Colorado. Our center is hosted by the City of Boulder, and we are part of a fantastic network of local, state, and national strategic partners that can help you during these challenging times. If your business is in Boulder County, you can find more information about COVID recovery, small business grants, and loans that you may qualify for at bouldersbdc.com. You can also ask for help navigating all of the programs. If your business is elsewhere in Colorado, go to coloradosbdc.org to find that information and the SBDC near you. We are recording this session at 10 a.m. on Wednesday, March 17th, 2021. Please note that we have everyone on mute and will take questions at the end of the session. So please enter your questions into the chat as they come up. A link to the recording of this webinar will be sent to you following the event. Now I will introduce our speakers, Dan King and Brian Ormsby, who lead our specialist COVID consulting team. Dan King's extensive career spans the fields of banking, real estate, hotels, restaurants, consulting, and property management. He has worked for HSBC Bank, HVS International, and has started 3 businesses of his own. He has been actively involved with the City of Boulder, was the chair of the Board of Directors for the Boulder Chamber of Commerce, and on the executive board for the Boulder Convention and Visitors Bureau. His areas of expertise include financial modeling, market analysis, and general business operations. Dan is a graduate of Cornell University's School of Hotel Administration. Brian Ormsby, founder and CEO at Pantheon Solutions, is passionate about helping small businesses succeed in the difficult terrain that is government compliant, accounting, and contract management. Brian is a U.S. Air Force veteran serving in cost and budget analysis. He spent 10 years as the Director of Operations and Program Manager with Pathfinder Systems, Inc., building simulators for the U.S. Department of Defense and NATO allies. Brian has extensive experience in cost and pricing. During his tenure at Pathfinder, Brian was responsible for all cost volume submission for the company's proposals to the Department of Defense and NATO allies, several per year. Brian currently specializes in helping firms manage their accounting and contracts with the Department of Defense, National Science Foundation, National Institute of Health, Department of Education, and NASA. Brian is a certified ISO 9001 quality auditor, as well as a Department of Transportation certified cost analyst. He holds a BS in management from Regents College. I will now turn this over to Dan King and Brian Ormsby. Thank you both so much for leading our conversation today.
Good morning, everybody. So I guess I'm going to jump in first, and then I will turn this over to Brian. We're going to do a really high-level view of the status of the current programs. The American Rescue Plan, which was passed a couple weeks ago, made a lot of changes to the existing programs, and we'll try to cover the major one of those, and then created some new programs which are being unveiled as we speak. And we have some information. We'll tell you what we know, and we'll tell you what we don't know. I can't move on without saying Happy National SBDC Day, but more importantly, I have to say Happy St. Patrick's Day, because it's a rare event for me to actually be working on St. Patrick's Day. Usually by now I'd be in a pub someplace and I've had told a few toasts. So I'm going to start with one toast because I have to get one out of my system since I can't go to the bar today. And I think this toast is both appropriate for St. Patrick's Day, but it's also appropriate for small businesses, because as small businesses, we're up against it. And I think the moral of this toast will ring true for small businesses. So without further ado, here's my toast for you today. The whiskey was spilled on the barroom floor, and the bar was closed up for the night. The little brown mouse came out of his hole, and he sat in the pale moonlight. He lapped up the whiskey from the barroom floor, and back on his haunches he sat, and all night long you could hear him roar, "Bring on the gosh darn cat." And I think as small businesses, sometimes we just have to say, bring on the cat, and we're going to take them on. And a lot of us have been doing that the last year and have a ways to go. So now on to the actual business of this meeting, and I'll turn the speaker over to Brian.
Thanks, Dan. Yeah, I appreciate the cat story. And I do relate to that. As a small business, you feel like you're kind of taking on the world at times. And it's nice to be empowered where you feel like you can. So we're going to go through a few programs here. We'll start with EIDL. The biggest differences in EIDL since the last time we talked is the deferment of payments extension. So we don't know a lot about how this is going to be administered. We just know that it's out there. So I actually know a few clients that have actually started their payment plans. So, you know, we're looking at what we think will happen will be a notification from the SBA telling them about their deferral and asking them to kind of set up their payment plans based on the new rules. So, so your deferral originally was 12 months for loans that were given in 2020, and now that has moved to 24. So you've actually got another year to defer before you make your first payment. Doesn't mean you have to take the deferral. You can start paying back if you want, but it gives you the option to take the deferral if you feel like you need a little bit more runway and a little more room before you have to start making those paybacks. And then for EIDL loans that were issued in 2021, they've added 6 months to the deferral. So then there's some additional funding for the EIDL targeted advance as well. We talked about the target before. The general rule here is that the SBA will be inviting targetees. We've seen some people who had invitations given already. So we know that process is working. So initially, the process of invitation was initially extended to people who received EIDL advance, but did not receive the full EIDL advance of $10,000. Those people were basically reviewed and determined who was going to be invited to the target. So then the next group of people will be the people who applied for and were denied. If you didn't apply for the EIDL advance, I don't know that you'll be found in the system. There doesn't seem to be any way to touch those people. But we kind of have to wait and see who actually gets an invitation to that targeted EIDL advance. Did I miss anything, Dan?
Oh, I think you're good.
Okay. Yeah, so let's talk a little bit about PPP. So PPP, as always, is continually changing. So when we went through PPP last year, there were 30 plus, I believe it was 37 interim final rules. If you go to the frequently asked questions on PPP at the SBA site, you'll find more than 80. So there's a lot of questions and there's a lot of changes that happened since PPP started about this time last year. So I'll kind of give you an idea of what we know. We've talked about some of this before, so I'll go into just a little bit. If you received PPP on the first round last year, you can go back and amend your PPP based on some of the new rules. And you need to contact your lending institution where you received your first round PPP to determine how you do that. If you did not receive PPP last year, did not apply, or didn't think you were eligible, or applied and were not eligible, and the new rules make you eligible, you can still apply for first round PPP. So the application deadline is March 31st. However, yesterday the House passed a bill extending to May 31st. However, that still needs to go to the Senate, and then from the Senate, it still needs to be signed by the president. We understand that there's bipartisan support, so we expect that to pass. But at this time, until it passes, hopefully by the end of this week or early next week, we still have to hang on to March 31st as the deadline. So if you have not applied, you need to do so relatively quickly. The interesting thing about PPP then, when they had the law that came out December 27th, was they passed a second round of PPP. So the second round of PPP is for those who received first round and now want to reapply for PPP for 2021. Again, that deadline is still March 31st, hoping to be extended another 60 days. Part of that with the law that passed just a couple of weeks ago was, well, actually wasn't part of that law. That came directly from the president, was to change the rule on sole proprietors so that instead of using line 31, which was the net on your Schedule C, you now get to use line 7, gross revenues. So that opens the door for a lot of businesses that had revenue that all their expenses brought it down to, little or no profit, or maybe even a negative number, where last year they weren't eligible to apply for PPP. Now that door is open. So if you did not apply for PPP because of that situation, you need to pick a lender and get an application in. That whole process was delayed because it kind of came on suddenly. But I think most lenders are up to speed with that process. So if you contact a lender and it sounds like they don't know, you have the option to pick a different lender. So, if you're talking to a lender and it sounds like they don't understand the rules, either elevate it within that lender so that you get someone who does understand the rules, or pick another lender. The second line, I kind of skipped over it, but I want to talk about this in terms of how much money is still out there. And this is one of the reasons we believe the extension is going to happen, is because 64% of the original fund has been spent, which means there's still money to be given. I think the intent here is to get all of those funds in the hands of small businesses so that they can use that money to help get past through this crisis. Again, with this change in sole proprietors, you have to be a Schedule C filer. You can't be a single member, S corporation and be eligible for the gross revenue piece. I think that's all I have. Dan, do you have anything to add?
Yeah, I think that's about it. The only thing that has happened, the other thing I'll add is that if you were early and you got on your application for the second draw right away as a sole proprietor, and you filed using line 31 and got your second draw PPP and approved and funded, there's no going back. That's your second draw PPP. You cannot go back now and amend that and try to get more based on line 7. We say that's the current stand. You cannot do it. As we've seen over the last year, sometimes things get changed later on. So, keep your antennas up. But at the moment, if you received a PPP filing using line 31 and you've got the money in the bank, that is your PPP amount. You can't amend.
Right, and that applies to second draw, but first draw is still amendable.
First draw is still amendable, but I don't think for the line 7. I think it's amendable for the additional insurance proceeds they put in, but I'm not sure it's amendable for line 7.
That's good.
Yeah, again, these things change quickly, so we give you the best we can. But I think that's it. I will
I'm going
move
to turn
on.
it over to you, Dan, for this one.
So the shuttered venue operator grant, this is only going to concern basically live venue operators. And we've done a webinar earlier where we talked about some of the general rules on who this applies to. It's a significant amount of money. And we're really just going to talk about the changes that happened more recently with this program. The most significant one of those is that the original rules were that as a business, you had to choose whether you were going to get a second draw PPP or whether you were going to try to get a shuttered venue operators grant. And once you filed an application in one program, you couldn't file an application in the other program. Well, they changed that a week or so ago. And now you are allowed to apply for and receive a second draw PPP. And you will still be, if you're eligible under the other rules, you'll still be able to apply for and attempt to receive a shuttered venue operators grant. Now, what they will do is if you're awarded the shuttered venue operator grant, they will subtract the amount that you already received in your second draw PPP. So they'll only give you the difference in the two programs. But we had a number of venues and businesses who are sitting on the sideline because the shuttered venue operator grant can be significantly more money. So they have been waiting, and they should no longer wait. They should get their second draw PPP application in, try to get that money in their bank, and they will still be able to try to get the increase in funding that they may be eligible for under the shuttered venue operators grant. Applications are still not open. The expectation, and it's actually a published expectation by the SBA now, is that the application process should start in early April. There have been significant new guidance that have been issued. The most recent was last Friday. I didn't look this morning. There could be new guidance this morning. They're continuing to develop the rules for this program. This again is a brand new program. It's not the PPP. It has different questions that need to be asked. So they've been constantly issuing new facts, and we keep watching them. We know we have a number of municipal entities who are wondering if they're going to be eligible for a shuttered venue operating grant. And the honest truth is we don't know. We have expectation that there's going to be guidance that will allow them a window to apply. That guidance does not exist as of today. And in fact, our reading of the facts as they exist today is there's a very small window for a municipal entity to get through, but we have expectations that that may change. This program, I think everybody should know this by now. In order to get the award from this program, you have to have a DUNS number, and you also have to be registered at sam.gov. DUNS is just a unique identifier number that businesses have to communicate with each other. So you need to file for a DUNS. That's one process. We do know that if you file for DUNS and specifically say the only reason that you want a DUNS number is because you're going to use it for working with the government, there's no fee for the DUNS number in that case. So look for that box to check when you're doing your DUNS application, if that is how you're going to use the DUNS number. Once you have the DUNS number, then you have to file and register with sam.gov. You have to have the DUNS number first. This process can take 3 or 4 weeks to get all the way through it. There's some new wrinkles that have been installed. There's actually on the sam.gov, there's now a button you can press that says, I'm only going to use this for government awards. So the only reason you're getting this is try to participate in one of these government awards. That will streamline the process for you. But there is an additional step that was added where after you get your SAM's registration, you have to send a notarized letter to the administrator of SAM program. I think this is a anti-fraud prevention. They're trying to make sure they've got real people in here. So that will add some additional timing to getting all the way through the process. So if you intend to apply for this, make sure you got your DUNS number and your SAM application well underway. I think that's what I have to say about shuttered venue. The newest program that came directly out of the American Rescue Plan is the Restaurant Revitalization Fund. We have a new acronym, RRF, that we can start throwing around. This is a brand new program, didn't exist before. Much like the shuttered venue grant program, it means they have to write the rules. So it means those rules have to be issued before we know exactly how this program will be administered and exactly how this program's applications will proceed. We do know a lot now, though, and we'll share what we know now with you. We also anticipate the rules for this program coming more quickly than the Shuttered Venue Operator Grant Program has, because the Shuttered Venue Operator Grant Program will be the template. So they'll rely on some of the decisions they made in that program to come up with the decisions for the RRF. The first thing we understand, I can't tell you this is 100% guaranteed, but it's pretty clear that our understanding is that it's going to be administered and awards will be made the same way the SVOG is, which means you need a DUNS number and you need to be registered with sam.gov. So if you're a restaurant and you think you're going to pursue these funds, get that process started now. The list of eligible entities is also directly from the bill, and it's a more inclusive list of entities than we've seen in the past. You can see it here on this chart, but it includes things like food trucks are definitely in there, saloons, lounges. You have the whole list here, but it's a larger list than just the sit-down restaurants that we may have seen before. Businesses that are specifically not eligible are publicly traded companies, companies with more than 20 locations, and you cannot apply for an SVOG and still apply for RRF. These are mutually exclusive. It's one or the other. Also, no state or local government operated businesses will be eligible for the RRF. The amount of the award that you can get for this program is significant. It's a damage calculation. So basically at the bottom of this chart, you'll see they're going to take your loss in revenue from 2020 versus 2019. That's going to be the amount that you're eligible for. But when they get to, before they get to your award, they will subtract the amount of any PPP funds that you have received. There are formulas available for businesses that weren't open all of 2019. But if you were open all of 2019, you're just going to take your annual number in 2019, your annual number in 2020, and do the calculation. I have a slide on the next one that will take us through a little bit of that calculation. I will say I took this slide directly from the National Restaurant Association meeting, which I attended on Monday. So I thank them for putting this information together, and I will use it to demonstrate. I'm not going to go through this whole slide. I'm just going to make a couple key points. I'm going to use my little highlighter here so you can see what I'm talking about. If I get my highlighter to work. The example they've given us here is Fraser Flapjacks. And they said this mythical restaurant earned or had revenue, they say earned, but it's revenue of $1.2 million in 2019 and $400,000 in annual payroll in 2019. They've already received 2 rounds of PPP funding in this restaurant, $83,000 in change in round 1, $116,000 in change in round 2, for a total of $200,000 received in PPP funding total. And you'll see that those numbers actually add up. The 83,000 is about 2.5 months of their annual payroll, and the 116 is about 3.5 months of their annual payroll, which restaurants were allowed to receive in round 2. I'm going to go into 2 of the scenarios, just the top one and the bottom one, so you can see how it works. In the top example, they say the restaurant's revenues are down by 50%, which means they've had a reduction in revenue of $600,000. Well, in this case, this restaurant would be eligible to receive an RRF of $400,000. The $600,000 are down in revenue. minus the $200,000 they've already received in PPP funding. Now I'm just going to go to the bottom one so you can see where it starts cutting out. In the bottom example, the restaurant is down 15%, which is a decline of $180,000. So in this case, the restaurant has already received more in PPP funding than they were eligible to receive under the rules of the RRF. So this restaurant will not be eligible for an RRF. Now, I don't want anybody to think that this means the federal government thinks they're going to have to give the $20,000 back. They aren't. They've already got that under the terms of the PPP. And as long as they spend it appropriately under those terms, they can have it forgiven and they can keep that money. But they would no longer be eligible for an RRF funding if their revenues were only down this amount. It's interesting to me that we have between the programs, there's a number of different definitions of what damages are, what amounts you have to be down by in order to be eligible, and it's all program specific. So when I compare this one to the EIDL loan program, which I think most of us know about, in that one, the damage calculation is your loss in revenue times your estimated cost of goods sold. I know that confused a lot of us in the beginning, but that is how they came out with it. And that is how the SPA really said, no, that's how we always calculate damages. Well, in this case, they are not doing this times cost of goods sold. It is the reduction in your total revenue. And that revenue amount, in theory, includes profit and includes all your other expenses. And that's the definition they're using for the damages for this program. So it's a different definition. I'll give a little plug to the National Restaurant Association because I think somebody did some good lobbying to get that definition accepted. And that's the one that you'll use in your calculations if you're a restaurant. A few other things I'll talk about with the RRF. At the meeting on Monday, the expectation is that the first rules and applications would be released in early April. That seems like a pretty optimistic timeline to me, but that is the expectation. And if they meet it, they're moving really quickly. There will be a 21-day priority period once the application opens, and that period will be for women-owned business, veteran-owned business, and disadvantaged businesses. I can't tell you the exact definition of disadvantaged businesses. It usually involves minority-owned or locational, maybe low-income area. That is yet to be spelled out. After that 21 days, the program will open for all other eligible entities, which with an expectation of that would be May or June for everyone else. There's $28.6 billion in total funding for this program. It's a big number. It's a big country. There's a lot of restaurants. I'm sure that money will be gobbled up, would be my expectation. They will specifically earmark $5 billion of that amount for businesses with less than $500,000 annually in revenue. So there's a carve out for small businesses. The covered period. So I throw covered period around like everybody should know what that means. And if you've lived in the PPP land like I have, you know what covered period means. So maybe let me define a little bit what covered period means. Covered period generally means for these programs, the period in which you can spend these funds. So there is a covered period for the RRF. Now, interestingly, that covered period starts February 15th of 2020. Nobody's received the money, but it goes back to the date of the pandemic starting. And it goes to the end of this year. So if you get an RRF, you will have to spend the money in accordance with the rules of the program between now and the end of the year. However, you will be able to spend that money on some expenses that you incurred prior to receiving the funds. So you'll be able to go back in, and there's going to be very specific rules, and I'm not going to try to go into those today, but you'll be able to go in if maybe you've built up some of your credit higher because you had to buy product to get through. You'll be able to use this RRF to bring those expenses down or maybe pay off some overdue bills. There is specific language about the tax treatment of this fund, these funds. You will know that most of you will remember there was lots of confusion around how the PPP was going to be treated for tax purposes. Well, in no uncertain terms, the rules say that these grants are not taxed like income, and all normal federal tax deductions are protected, which means you will not have to report it as income, and you will not have to reduce your expenses for tax purposes by the amount of this fund that you use to pay some of those expenses. So that clears up some of the confusion that we had with the PPP, and they eventually changed. It will now be done the same way the current rules for the PPP stand. I've used a lot of acronyms. I've thrown a lot of things around that I've talked about a lot the last year, so they make sense to me. Hopefully they make some sense to you as well. I will stop talking and let Brian come back in to talk about the Colorado Climbers Fund.
Yeah, thanks, Dan. So speaking of acronyms, we got a new one, Climbers. So when I first read this, I didn't understand what Climbers meant, and then I had to go to the website and look it up. So Climber actually stands for Colorado Loans to Increase Mainstream Business Economic Recovery. So that is what the purpose of the term or acronym Climber is. It is a state program. There's $250 million in the Climber Fund. But it is a loan fund. So it is for must have a history of being a successful business. So this is specifically for businesses that were successful prior to COVID, that have been hit hard by COVID, and need assistance to climb out of that hole with the expectation that they will return to the success that they were enjoying prior to COVID. So you can see that you have to have 2 consecutive years of positive cash flow within the last 5 fiscal periods, leading up to February of last year. So this DSCR is an acronym for, I can't even remember now, but it is the ability to pay off your credit. What's that?
Debt service coverage ratio.
Right. So, it's the difference between the amount of operating cash you have and the amount of debt you have. So it has to be at least 1-to-1, meaning you have enough operating capital to pay your current debt ratios or your current debts. Obviously, the higher that number is, 2-to-1, 3-to-1, 4-to-1, the better off you are. So, and that would be your ratio prior to the pandemic term, February 29th last year. So the use of these funds are for working capital. Again, it is a loan. It is going to be managed by lenders. We don't know what that lender list is yet. If you go to the website, there's still a spot there for lenders to sign up so that they can, go and administer these loans. So what we know is your loan amount can be between $30,000 and $500,000. The deferral will be 12 months. The interest rate is going to be between 2.45 and 2.95. I don't, at this point, know how they're going to determine what the loan amount is and why you would get 2.45 as opposed to 2.95. My guess is that it is probably based on ratios and risk, but it is a guess. I don't know about the balloon. That's something that's new to me, Dan. Can you explain that?
Yeah, I can add a little more insight on a couple of those points. So the interest rate is actually set forth in some of their documentation. It's based on the term of the loan. So if you take this loan with a 1-year term, 1-year amortization, you're going to get the lower interest rate. If it's a 5-year amortization, you will get the higher interest rate. I'd like to clarify the payment deferral is up to 12 months. The program is actually written that automatically you get a 3-month deferment of principal and interest payments. That's what you get automatically on these loans. The lender can then increase it by increments. They can increase it to 6 months. I think they can increase it to 9 months. But if the lender decides to increase it to the full 12 months, they have to get approval from CHFA. CHFA is the governmental organization that's going to oversee the administration of these loans through the banking industry. And the final point on the balloon payment, the program is intended that all of these loans will be fully amortized over whatever that term is, the 1 year to 5 year term. So that's the intention, that it's going to be fully amortized over those terms. However, it specifically does say that CHFA can approve a balloon payment at the end of up to 20%. So if it's a strong application for other reasons, CHFA can approve that you would amortize 80% of the loan over the term and have a balloon payment left of 20% at the end of that term.
Thanks, Dan.
Yep. I think that's it on Climbers Fund.
Yes, back to you.
Yeah, well, pandemic unemployment. So I think everybody knows these are general things, provisions, maybe not specifically related to business, but certainly around the periphery of where we live that were in that bill. The pandemic unemployment assistance at $300 a week was extended through September 6th. And there's also the pandemic emergency unemployment compensation, which was extended through September 6th as well. If you want to know the difference, the real difference is that the PUEC, I think I've got the acronym wrong, is for people who have used all their unemployment benefits up in the state system. So they can file under that. The PAU or PUA, I definitely had dyslexia when I did this slide, are for people who still have remaining benefits in the Colorado unemployment system, and they just get a supplemental amount. There is $10 billion in the legislation that is going to be distributed to state government to stimulate lending. How that's going to come out, we don't know. Each state will come up with their own programs and their own rules for how they want to get that money out into the market. So there's going to be a lot of developments over the last year. We know there's a bunch of legislation right now pending in the Colorado legislature with many different programs that might have funding for different industries or different categories. You know, none of those are real until they get passed and approved and signed into law by the governor. So we won't go into any of those today. There's also numerous tax codes, provisions, and revisions in the American Rescue Plan. That's our general overview, folks. I think that's where we're going to end our formal presentation, and we will be happy to entertain questions.
Oh, thank you, Dan and Brian. We really appreciate it. We really appreciate your candor as we're all reacting to some of the changes as they come up. And it's hard to make decisions when you have uncertain information. So thanks for telling us what you are certain of versus what we think is going to happen. Okay, so we've got a bunch of questions. Bear with me a minute. I'm gonna be jumping all over the place on you. So, but I know you guys are good at this part. Okay, so is there any quick information about how to enter EIDL loans and PPP loans in this person's accounting system, which is QuickBooks, which is the default? If there's not quick answer, we can come back to that at another time. But what would you say about that?
Yeah, so the entry of the loan initially should be, I received cash, and then I have made a new account in my chart of accounts, a balance sheet account for, and I've been calling them short-term assets because we expect them to go away. EIDL would be a long-term, PPP would be a short-term. How you put them in your QuickBooks, whether you put long or short-term is pretty immaterial because it's going to go on the bottom half of your balance sheet. So that's how you put it in the system. We receive cash and I've created a liability. Now, idle, when you pay it off, you're going to need to figure out an amortization schedule. From what I've seen so far, the SBA is not providing that. So you can Google an amortization schedule and stick that in for idle. So when you pay off idle, every time you make a payment, a part of that payment will be principal against that loan, which will lower the liability on your balance sheet. Another part of that will be interest, which should be an interest expense on your P&L. PPP, if you're fully forgiven, should come off your balance sheet. Typically, it will go onto your profit and loss. You can do it one of two ways. You can put it in as other income, or you can put it in as a negative expense. That's going to change your P&L bottom line, but you have to remember that that bottom line is going to be forgiven when you file your taxes at the IRS. That's the short answer. If you have a more complicated answer, contact me offline.
Yeah, I think there's a better answer that Brian, that's a Brian answer. I wanted to say something about the idle loan that maybe we should have mentioned before. So we mentioned that the payments are deferred for another year, which is good news. They are going to keep accruing interest over that year. So that will be added to your principal balance when you do start making payments.
Okay, so Dan, thank you. You just answered Ula's question about accrued interest, and there are several others that come up about accrued interest. So thanks for being clear on that. Let me go back to Brian. I want to offer again that the SBDC offers free assistance. Brian is one of our consultants. So if you're in Boulder County, bouldersbdc.com. If you are in the rest of the state, Colorado, sbdc.org. And literally, we can help you navigate that first question about entering in QuickBooks. Okay, are there any indications that idle loans might be forgiven in conjunction with upcoming new federal programs? Specifically, the question is about restaurants, but it really relates to everybody.
Yeah, there's nothing in the wind. Doesn't mean it won't happen, but there's certainly nothing in the wind. We try to keep our finger on the pulse of what's going on. A lot of times we'll get things out of local representative's office or state representative's office to tell us they're trying to put a bill in. We have heard nothing that is in even the proposal stage for idle loan forgiveness.
Okay. There's a lot of confusion on the ERTC, the Employee Retention Tax Credit. If you took PPP-1 and PPP-2, can you still qualify for the Employee Retention Tax Credit?
Yes, you can. So the key here, and you need to pay attention to how you apply for forgiveness if you're going to apply for the Employee Retention Tax Credit, because where we have advised people before, without respect to Employee Retention Tax Credit, that the easiest way to apply for forgiveness is just to extend the period and use all payroll. If you're applying for the Employee Retention Tax Credit, that is not good advice. The best way, if you're going to apply for Employee Retention Tax Credit, one is if you have a payroll provider, contact them, they will help you. Two is to maximize the 40% of your PPP forgiveness on non-payroll items, because the payroll items part of your PPP forgiveness will be reduced from your Employee Retention Tax Credit.
Something just came up in the chat that I want to mention. We will follow up and send this recording to everyone who registered for the webinar. So if you came in a little bit late and you want to catch up, please don't be concerned. Okay, what about the sole proprietors who started their business in 2020 and don't have a Schedule C to go off of, but can show a decrease in sales gross revenue? Can you give some insight there? And you might want to tease that out into a few different things.
Well, let's start with one part of that. When did you start in 2020? You for almost all of these programs, you have to have started your business prior to the start of the pandemic. Now, there's some different dates that float around for some of these. So I'm not going to try to get specific. Right? There's some are a February 15th date, some are a date in March when the emergency was declared, depending on where you live. So you have to look at each program, but you have to have been in business before, for most of these programs, before that date to have been damaged. Otherwise, well, you started during the COVID. So your eyes were wide open and these programs aren't for you, unfortunately. There may be other ones that are, and there may be other places that you can look at to get some help, but most of the programs won't apply. There are specific rules, and again, they vary by program. So you have to get into which program are you looking at, the details of the program, but there are some that will let you take, if you had January and February 2020 numbers, you can take those 2 months. You may be able to annualize that to here's what my average monthly thing would have been, and then compare that to what you actually did post that time frame. So there are mechanisms for you to do that. They vary by program. They're usually spelled out in some of the facts. So you need to look at the specifics.
Okay, thanks. And we actually got a similar question. I just want to make sure that it is exactly the same. Are there any grants or loans for startup businesses? That is what you answered, but it is possible it was a startup business that actually is within the right start time. They were in business at the right time. Could you maybe talk about how that works?
Okay, so I guess I'm going to answer that 2 different ways. One, are we talking about just normal loans, or are we talking about some of these specific pandemic relief programs, COVID relief programs? So most of the COVID relief programs, the answer is going to be what I tell you. There's, depending on the type of program, there's specific language about how you can take a part year and annualize that to compare to come up with a revenue reduction. For startup loans in general, I mean, there are lenders who make loans to startup businesses under normal circumstances. Some of those can be SBA-backed loans, which will have some better financing terms, maybe some lower interest, maybe some deferment on payrolls and interest. But those are loans that are going to be underwritten through the normal banking process. So you are going to have to be credit scored for those. And somebody's going to look at your projections and your cash flow and all those things that you would normally for any loan get. There may be some relaxed criteria, but you're still going to have to pass some sort of credit underwriting standard to get those loans. But there are products out there if you can meet those tests.
Okay, thank you. Last year, there were many grants. I'm going to ask you both, and if you want to throw it back at me, feel free. Last year, there are many grants offered by the city, county, and the state that were sponsored by the CARES Act. Will there be similar grants this year? And then the main question is, when will we know about them? So take it away.
You know, part of this latest bill was to push more money to state and local governments so that they would have the ability to do these things targeted to the communities in which the crises have happened. So that, because each community is a little different. What affects Denver is probably greatly different than what affects San Francisco. So there is more money in the pipeline. Now, how that's going to come down and what's going to be offered is still remains to be seen. But we do have an expectation that there will be state and local programs. So keep your eye on the SBDC websites because that's it's a very good location to where these grants and things will appear once we know about them. But quite frankly, other than some rumors of what might happen, we don't have any guidance based on the latest round of funding. Sure,
and I'll just plug a little bit too that I guess I can say this, Sharon, because I know we're working on it. The SBDC, Boulder SBDC is working on a pretty significant upgrade to the website that will list programs, grant programs, and we have a commitment to keep that current. It'll probably become active in the next couple of weeks, but pay attention to our email. We'll announce that too. And And that's going to be a site that we're going to really work on having current information as these programs arise, because we don't know when they're going to come out. We don't know what they're going to be. And it's not worth us when we start hearing rumors, well, the state legislation's talking about doing another round of energized gap fund. Well, great, but we're not going to put it up there until it's passed and we know that it's actually happening.
Okay, thanks. Needless to say, we're all watching closely as you are. I think you answered this one, but I'm going to ask it again. Can you get a PPP and an RRF if you are a retail goods store?
We would have to go back to that definition of the eligible entities for the RRF that I put up. I can put that back up on the screen if we want. I don't think that retail was in there. And again, that's the language specifically from the bill. That's straight out of the legislation. As we know, that language then gets interpreted by the SBA, and they come out with facts, and they come out with additional details and additional guidance. My quick answer is I don't think a retail was in that language, but I guess pay attention and check back in with us and watch as the rules come out.
Okay, you may need a little bit more information to answer this one, but how does total revenue get calculated? Is it total income? Is it profit, which is total income minus cost of goods sold? Is it profit minus expenses?
Yeah, so I think the best guidance is to pull Schedule C and look how line 7 is calculated, because it is not just total receipts.
And I think that's good advice. And then I'm just going to throw in that, which program are you asking about? Because there's different definitions. And so specifically, the Shuttered Venue Operators Grant, there's a definition that it's total gross earned revenue. So venues, museums and stuff have a lot of unearned revenue. They get donations. They may have memberships that are donations. That stuff doesn't count. That's unearned revenue. It's only their earned revenue, what they get from selling a product or a service. So they have one definition. The Restaurant Relief Fund is going to have a different definition, and we don't have the details of that definition yet. My expectation is it's going to be pretty close to your total revenue. The total revenue that you collect and pay sales tax on, and that portion of it that maybe is tax exempt if you have some tax exempt clients, but it's going to be pretty close to what you consider your total revenue, but the details are forthcoming still.
So this is a specific question, but it actually might broaden to more than that. Can covered expenses under the RRF program and the covered expenses under the PPP funding be the same expenses, or are those costs used to apply for PPP forgiveness set aside in the RRF calculations? I think I lost the thread there at the end, but you see where it's going.
Ryan, or I can jump
Yeah,
in.
I mean, it's up to you. There is no double dipping.
Yeah, there's no double dipping. That's a principle. You can't pay the same bill twice with federal government money. I'm just going to throw in that the allowable expenses that you can use for PPP funding are much more restricted than what you're going to be able to use RRF funding for. The RRF funding definitions to date are very broad, way broader than the PPP. So there's going to be many, many more allowable expenses. There's language there. We can get you that language as it exists today. But again, the facts are going to come out in the next couple of weeks, and that's where the real details will come.
Can you request additional idle loan funds if you showed a loss at the end of the year, but the end of the year was before the revenue?
So
let's just go with, can you request additional idle loan funds?
So going back and revisiting your idle loan is not going to happen. So unless you're invited to this new targeted idle process, that will be the only way idle is revisited.
I think I might have a caveat for that, though. I think that if you were approved for an amount of an EIDL loan in the first round and you took something less than you were approved for, you may be able to go back and request an increase to the amount that you were offered the first time. You may be able to do that. You would have to go through the SBA. Each one of your loans comes with contact information. So there's different centers around the country, SBA centers that handle these loans. And in your loan documentation, there's a unique, well, a center, a contact number for your loan. And you would have to reach out to them and see if that's a process you can initiate, expect it to take some time, so.
Okay, thanks. So this is a question about PUA, and I think that's the right acronym, but I could be wrong, and PPP. Can a sole proprietor who is receiving PUA funds receive a PPP loan?
Not concurrently, double
Right.
dipping. No
Yes,
double dipping.
you can't double dip. However, for example, if you're receiving PPP funds, if you're eligible for forgiveness during the forgiveness period, it's kind of complicated, but if you took a little unemployment, but still during the forgiveness period still had enough non-unemployment periods to be eligible for forgiveness, then that is possible. So as long as none of those times overlap.
Okay, can you review the current state of PPP forgiveness applications?
Yeah, it depends on who your lending institution is. There's several lending institutions that have not even opened up the portal for forgiveness. There are several lending institutions who have done that quite a while ago. So it depends on your lending institution. If you are unaware of where they are, contact them and find out. My lending institution just opened their portal 3 days ago. However, their portal has no way to get into it. So it just depends on who your lending institution is.
And then as a follow-up, is there any deadline for submitting forgiveness? Is there anything you could speak to on that?
Yes, and so the deadline has been defined as, oh gosh, what was it? It's 10 months from the end of the forgiveness period. I had to kind of dig. I've got a little.
This is a test.
Yeah. Well, there's so much information, but it's still 10 months from the end of the forgiveness period. So depending on when you got your loan and what your forgiveness period was, based on the terms at the time you got your money, you have 10 months from the end of the forgiveness period, which could be 10 months from as late as December 31st.
We have 3 minutes. I'm going to try to zip through a few. Please know that we will be able to follow up with you with some other answers as well. And I'm going to turn it over to Rachel in 1 minute. Are we hearing any talk about adding S-Corp pass-through income to PPP loan amounts?
No.
That's quick. And this is someone who came in a little bit late. Is the RRF program a forgivable loan similar to the PPP?
It's a grant program. If you get it, it's a grant. Now, is there gonna be some review? Like, yeah, because you can only spend it for allowable expenses, and are you gonna have some sort of reporting you're gonna have to do at the end of it? Yes, I'm sure you are gonna have some portion, but it's a grant program. As long as you spend it, you spend it all, you spend it on appropriate items, you don't pay it back. What happens if you don't spend on appropriate items? I don't know.
Okay, so I'm going to hold it. We have other questions here, but they're kind of getting in the weeds, and many of you we know well, and we'll follow up with you and answer those questions. You know who you are. If anyone does not have a question answered, My email is sharon.king@bouldersbdc.com. Put in the subject line, Sharon in caps, and we'll try to get an answer for you from Brian or from Dan. So thank you both. I'm going to turn this back to Rachel to close us off.
Well, thank you everyone for joining us today. We do have a webinar at 2 p.m. Marketing Essentials. So if you want some marketing tips for 2021, please join us. And we will be following up with a recording to this session today. Special thanks to Sharon and Judith for moderating the Q&A and chat, and Dan and Brian for their expertise. Thanks everyone.
Solancha.